Before we begin, a quick disclaimer. I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only and should not be considered legal or financial advice. The information provided is based on general principles of personal auto insurance in the United States, but policies and regulations can vary significantly by state and by insurance carrier. Always consult with a qualified, licensed professional and read your own policy documents carefully before making any decisions about your coverage. Imagine this for a second. You're driving home after a long day. It's dusk, the rain is starting to come down, and out of nowhere, a deer leaps across the road. You swerve instinctively. You miss the deer, thank goodness, but you lose control for just a second. You hear a sickening crunch of metal and splintering wood. You've crashed through your neighbor's brand new, custom-built, $60,000 fence. Your heart is pounding, but you take a deep breath. You're okay, and you have insurance. That's what it's for, right? You make the call, explain what happened, and then you hear the 5 words that make your blood run cold. I'm sorry, that's not covered. Your stomach drops into your shoes. How? How is that even possible? You pay them hundreds of dollars month after month, year after year. You have full coverage. It's a phrase we all use, but what you're about to discover is that full coverage is a myth. It doesn't actually exist. It's a marketing term, and the gap between what you think you're paying for and what your policy will actually pay for is a financial time bomb ticking in the glove box of nearly every car in America. That is the exact problem we are going to solve right now. This isn't just another boring video about insurance. This is your decoder ring. This is the guide that will translate that dense, confusing 50-page legal document they sent you into plain, simple English. We are going to tear apart a standard American auto insurance policy piece by piece so that you understand with absolute certainty what you are protected from, and more importantly, what you are not. By the end of this, you won't just be a more informed consumer. You'll be in control. You'll know how to spot the gaps, avoid the traps, and build a policy that actually protects your family and your future from financial ruin. Because let's be honest, it feels intentionally confusing, doesn't it? They throw around words like liability, collision, comprehensive, subrogation, tort, statutory limits. It's designed to make your eyes glaze over. It's designed to make you just sign on the dotted line and trust that the standard package is good enough. But good enough is what leads to that horrifying phone call. Good enough is what leads to people losing their homes and having their wages garnished for years, all because of one bad swerve on a rainy night. So let's pull back the curtain. We're going to start with the absolute foundation of every single auto policy in the country. It's the one part you are legally required to have, and it is, without a doubt, the single most misunderstood piece of the entire puzzle. I'm talking about liability coverage. If you remember nothing else from this entire video, remember this. Liability coverage has absolutely nothing to do with you, your injuries, or your car. Zero. It is not for you. Liability coverage is for the other guy. It exists to pay for the damage that you cause to other people and their property. You cause an accident? Your liability coverage pays to fix their car. Your liability coverage pays for their medical bills. It is your financial shield to protect you from being sued into oblivion by the people you hit. That's it. It's I'm sorry insurance. Now on your policy declaration page, you'll see your liability limits written as a series of 3 numbers, separated by slashes. It might look something like 25/50/25, or 50/100/50, or 100/300/100. This isn't a secret code. It's the exact dollar amount in thousands that your insurance company will pay out on your behalf. Understanding these 3 numbers is the key to everything. Let's break down that first example. 25/50/25. The first number, 25, stands for $25,000. This is the maximum amount your insurance will pay for any one person's bodily injuries in an accident you cause. Bodily injury means their medical bills, their lost wages, their pain and suffering. So, you run a red light and T-bone another car. The other driver has to be taken to the hospital. They have a broken arm, whiplash, and need physical therapy for months. Their total medical bills come to $40,000. Your policy has a limit of $25,000. The insurance company writes a check for $25,000, wishes you the best of luck, and their job is done. So, where does the other $15,000 come from? Comes from you, directly from your pocket. They will sue you for it. They will get a judgment against you. And they will come for your savings account, your paycheck, your assets, whatever it takes to get that $15,000. All because that first number was too low. Now for the second number, 50. This stands for $50,000. This is the maximum amount your insurance will pay for all bodily injuries combined for a single accident. Let's go back to that T-bone accident. But this time, the other driver had 2 passengers in the car with them. All 3 people are injured. Person 1 has $20,000 in medical bills. Person 2 has $20,000. And person 3 has $20,000. The total for all of them is $60,000. Now, your limit for any single person was $25,000, so you're good there, right? No one person went over that limit. But your total limit for the entire accident is only $50,000. The bills are $60,000. You are now personally on the hook for that $10,000 difference. Again, they will sue you for it and they will win. Are you starting to see how this works? The insurance company's responsibility ends precisely where those numbers on your policy say it ends. Every single penny beyond that becomes your personal nightmare. And that brings us to the third number, the final 25. This stands for $25,000. This is the maximum amount your policy will pay for property damage you cause in an accident. This is for the other person's stuff. Most of the time that means their car. But it also includes that fence you crashed through, or the mailbox you ran over, or the storefront you skidded into. Now let me ask you a very serious question. Look around you on the road today. How many cars do you see that cost less than $25,000? The average price of a new car in the United States is now nearly $50,000. You cause an accident and total someone's brand new Ford Explorer or Honda Pilot. The replacement cost is $50 grand. Your policy pays its limit of $25,000. You are now personally getting a bill for the other $25,000. This is the state minimum trap. Most states have a legally required minimum amount of liability coverage you need to have just to register your car and drive on the road. And for millions of people, that's exactly what they buy because it's the cheapest option. But the state minimum isn't designed to protect you financially. It's designed to provide a tiny, minuscule cushion for the victims of an accident. Following your state's minimum requirement is some of the worst financial advice you could ever take. It is a recipe for absolute disaster. It leaves you catastrophically exposed. The single biggest mistake people make is thinking that liability coverage is for them. It is not. It does nothing to pay for your hospital bills. It does nothing to fix your totaled car. It is purely 100% for the other people involved in an accident you cause. So what happens when your car is the one that's a twisted wreck on the side of the road? What covers the thousands or tens of thousands of dollars to repair or replace it? And what about your own medical bills if you're injured? That's where the other parts of your policy are supposed to step in. And the 2 types of coverage that handle your car are the ones people confuse all the time, often with devastating consequences. These 2 coverages are collision and comprehensive, and the confusion between them is the single biggest trap in auto insurance. Most people hear the term full coverage from a dealer or a friend and assume it's a magical shield that protects them from everything. Let me be crystal clear. Full coverage is not a real insurance term. It does not exist. It's a marketing phrase, a piece of slang that has caused more financial ruin than you can possibly imagine. What people usually mean when they say full coverage is that a policy includes both collision and comprehensive. But even then, what they actually cover and how they work is what really matters. Let's start with collision. The name is pretty straightforward, but its application is wider than you might think. Collision coverage pays to repair or replace your car after it's damaged in a collision. This is the coverage that kicks in if you rear-end someone. Remember from the last part, your liability coverage paid for the other person's car. Your collision coverage is what pays to fix yours. It also applies if you're the victim of a hit and run, or if you get into an accident with someone who is uninsured. But here's where it gets interesting. Collision isn't just about hitting another car. It's about your car hitting an inanimate object. Did you back into a light pole in a parking lot? That's a collision claim. Did you swerve to avoid a squirrel and hit a guardrail? Collision claim. Did you misjudge a turn and scrape your entire side against a concrete pillar in a parking garage? That's a collision. It even covers your car if it flips over in an accident. Essentially, if your car is in motion and makes an impact that causes damage, you're looking at a collision claim. Now, this is where the most important number on your policy comes into play. Your deductible. The deductible is the amount of money you have to pay out of pocket for a repair before the insurance company pays a single penny. Let's say you have a $500 collision deductible. You get into that fender bender, and the body shop quotes you $5,000 to fix your car. You are responsible for the first $500. You pay that to the body shop, and your insurance company will then pay the remaining $4,500. If the damage is only $400, your insurance pays nothing. It's all on you because the cost of the repair is less than your deductible. This is a fundamental trade-off. A higher deductible, say $1,000 or $2,000, will lower your monthly premium because you're agreeing to take on more financial risk yourself. A lower deductible, like $250 or even $0, will make your premium higher because the insurance company is on the hook for more of the potential cost. Choosing that number is a gamble on your own future. So, collision covers your car when it hits something. Simple enough. But what about all the other horrible things that can happen to a car that don't involve a crash? This is where the second, and arguably more misunderstood, coverage comes in: comprehensive. The official name on many policies is actually other than collision coverage, which is a perfect description. Comprehensive pays for damage to your car from almost anything that is not a collision. It's the coverage for the chaos of life. A windstorm knocks a massive tree branch onto your roof, shattering your windshield and caving in the top? That's a comprehensive claim. You walk out of the mall to find your car is just gone? Stolen? Comprehensive covers the theft and replacement of your vehicle. And here is the one that trips up everyone, the classic bar trivia question of insurance. You're driving down a country road at dusk, and a deer leaps out in front of you. You can't stop. You hit the deer. Is that a collision claim or a comprehensive claim? Your brain says collision, right? You collided with a deer. But insurance companies classify hitting an animal as a comprehensive claim. Why? Because the event is considered largely unavoidable, an act of nature much like a hailstorm. Swerving to avoid the deer and hitting a tree, however, that's a collision claim because you were in control of the vehicle when it hit the tree. That single distinction can have a massive impact on your rates and your record. Comprehensive covers a huge list of unfortunate events. Vandalism. Someone keys your car or smashes a window. Fire. Flooding. Your car gets submerged in a flash flood. Hail damage that makes your hood look like a golf ball. A rock kicked up by a truck on the highway that cracks your windshield. All of these are handled under comprehensive coverage. And just like collision, comprehensive has its own deductible. Sometimes it's the same amount as your collision deductible, but you can often choose to have them be different. For example, you might have a $1,000 collision deductible, but only a $100 deductible for glass replacement under your comprehensive coverage, since windshield cracks are so common. So why is the distinction so critically important? Why did I call the confusion a trap? It comes down to two things: fault and money. A collision claim, especially one where you are at fault, is a major red flag for insurance companies. It signals you are a higher risk driver, and your rates are very likely to go up at your next renewal. But a comprehensive claim? Hitting a deer, getting your car stolen, or having a tree fall on it. These things are generally not considered your fault. They are random acts. Because of this, a comprehensive claim often has little to no impact on your insurance premiums. It's seen as bad luck, not bad driving. And this brings us to the devastating consequences. Imagine a young driver. Let's call him Alex. He just bought his first nice car. He has a car loan, and the bank requires him to have full coverage. Alex, trying to save money, looks at his policy options. He sees a high premium and wants to lower it. He thinks, I'm a safe driver. I won't get into an accident. So he keeps his collision coverage as required by the bank, but sets a very high deductible, like $2,000. Then he looks at comprehensive. He doesn't even really understand what it is. Other than collision, what does that even mean? Fire? Flooding? That'll never happen to me. To save $50 a month, he rejects comprehensive coverage entirely. 6 months later, Alex parks his car at a movie theater. When he comes out, the spot is empty. His car has been stolen. He calls the police, then he calls his insurance company, panicked but thinking, at least I have insurance. The agent on the phone asks him a few questions and then delivers the soul-crushing news. I'm sorry, Mr. Smith, but your policy does not have comprehensive coverage. We can't help you. Alex is in shock. He still owes $25,000 to the bank for a car he no longer has. The bank doesn't care that it was stolen. The loan is his responsibility. He has no car to get to work, and now he has to keep making a massive monthly payment for the next 5 years on a ghost. That $50 a month he saved has now cost him $25,000 and put him in a position of potential financial ruin. That is the trap. That is the devastating consequence of not understanding what your policy actually covers. Collision and comprehensive are not luxuries. If you have a car loan or lease, they are mandatory. And even if you own your car outright, you have to ask yourself a hard question. If my car were totaled tomorrow in a flood or stolen from my driveway, could I afford to replace it with cash, right now, without causing a major financial crisis in my life? If the answer is no, you need these coverages. So we've covered damage you do to others, and we've covered damage done to your own car. But we've left out the most important thing inside that car. What happens when you're the one who gets hurt? Who pays for the ambulance ride, the emergency room, the surgeries, the weeks of physical therapy? What if you can't work for months because of your injuries? Who covers those lost wages? The answer is a terrifying patchwork of coverages that most people have never even heard of. And not having the right ones is like driving with a financial time bomb strapped to your passenger seat. Let's start by disarming that time bomb. This terrifying patchwork of coverages is actually a series of safety nets, each designed to catch you in a different way when things go horribly, horribly wrong. And the first, most important thing to understand is that your auto insurance policy is split into two fundamental parts. There's the part that protects other people from you, and there's the part that protects you from other people. And from yourself. We're going to start with the selfish part. The part that's all about you, your passengers, and your financial survival. The first layer of this personal safety net is called medical payments coverage, or as it's commonly known, MedPay. Think of MedPay as the fast-acting pain reliever of your car insurance policy. Its job is simple: to pay for immediate and necessary medical and funeral expenses for you and anyone in your car who gets injured in an accident, regardless of who is at fault. Let that sink in. Regardless of fault. This is huge. Imagine you're in a minor fender bender at a four-way stop. You say he ran the sign, he says you did. Your 7-year-old in the back gets a bloody nose from the jolt and needs to be checked out at an urgent care center. Are you going to wait weeks, maybe months, for the insurance companies to battle it out and assign blame before you get that bill paid? Of course not. With MedPay, it doesn't matter. You file the claim with your own insurance and they pay that urgent care bill right away. No fighting, no waiting. It covers ambulance rides, doctor visits, hospital stays, x-rays, even dental work if you chip a tooth on the steering wheel. And here's the kicker. There's usually no deductible. If you have a $500 MedPay limit, you get to use that first $500 without paying a cent out of pocket. It's also incredibly broad. It covers you and your family members not just in your own car, but if you're riding as a passenger in someone else's car. It even covers you if you're hit by a car as a pedestrian or while riding your bike. Now, the most common objection I hear is, "But I have great health insurance. Why do I need MedPay?" It's a fair question, but it misses the point. First, what's your health insurance deductible? $1,000? $5,000? $10,000? MedPay can pay for your initial expenses before your health insurance even kicks in, effectively covering your deductible for you. Second, health insurance has co-pays and co-insurance. MedPay doesn't. Third, your health insurance might not cover certain things, like ambulance services from specific providers or chiropractic care. MedPay often will. And most importantly, what about your passengers? Your friend, your coworker, your nephew you're driving to soccer practice. Are they on your health insurance plan? No. But if they're injured in your car, your MedPay can cover their initial medical bills, which can go a long way in preserving a friendship after a traumatic event. MedPay is cheap, it's fast, and it's a no-brainer layer of protection. But in some states, they take this concept even further. If MedPay is the fast-acting pain reliever, then our next coverage is the full-blown emergency room trauma care. It's called Personal Injury Protection, or PIP. If you live in a no-fault state like Florida, Michigan, or New York, to name a few, you're likely required to carry PIP. The whole idea of a no-fault system is to reduce lawsuits by having each driver's own insurance company pay for their injuries, again, regardless of who is at fault. So, PIP is essentially MedPay on steroids. It covers all the same medical expenses that MedPay does, but it goes so much further. Remember that question from before? Who covers your lost wages if you can't work? PIP does. If you're a freelance web developer and you break both your wrists in a car accident, you can't type. You can't work. Your income grinds to a halt. Your health insurance will pay the doctors, but it won't pay your mortgage. PIP steps in and can reimburse you for a percentage of your lost income while you recover. But it doesn't stop there. What if your injuries are so severe you can't take care of your own kids, or clean your own house, or even cook a meal? PIP can cover what are called essential services. It can help pay for childcare, a cleaning service, or meal delivery. It provides a financial cushion for your life to continue, even when you're physically unable to manage it. It even provides a funeral expense benefit in the worst-case scenario. PIP is a comprehensive safety net designed to put the pieces of your life, not just your body, back together after an accident. So we have MedPay for immediate medical bills and PIP for the broader economic fallout. These are fantastic for covering your expenses. But what happens when the other guy is clearly 100% at fault? He blows through a red light and T-bones you. His insurance should pay for everything, right? Your medical bills, your lost wages, your pain and suffering. That's how it's supposed to work. But what if he doesn't have insurance? Or what if he has insurance, but it's the absolute legal minimum required by the state? This brings us to the single most important coverage you can buy to protect your own life and livelihood. It's called Uninsured and Underinsured Motorist Bodily Injury Coverage. Let's call it UM/UM. This is the coverage that protects you from the nightmare scenario. According to the Insurance Research Council, about 1 in 8 drivers on the road in the United States is uninsured. That's more than 12%. In some states like Mississippi and Florida, it's over 20%. 1 in 5 drivers. They are a financial time bomb driving straight towards you. If one of them hits you and puts you in the hospital for 3 months, you can sue them. And you'll probably win. But what are you going to get? You can't get blood from a stone. If they couldn't afford insurance, they certainly can't afford your $500,000 medical bills and lost future earnings. This is where uninsured motorist coverage becomes your personal superhero. It steps into the shoes of the at-fault driver and pays you everything his liability insurance should have paid you. It pays for your medical bills, your lost wages, and that incredibly important, often overlooked thing called pain and suffering. It compensates you for the physical pain, the emotional distress, and the permanent impact the accident has on your life. Your own insurance company essentially pretends to be the insurance company for the guy who hit you, and they pay you. Now let's talk about the second half of that acronym, Underinsured Motorist. This might be even more terrifying. The guy who hits you does have insurance. He's a responsible citizen, except he bought a policy that only meets the state's minimum requirements. In California, for example, the minimum bodily injury liability is just $15,000 per person. $15,000. What does that cover? Maybe the ambulance ride and the first night in the ER. If you have a shattered femur that requires surgery, plates, and screws, your bills will blow past $15,000 before you even leave the operating room. Let's say your total damages, medical loss, wages, the whole thing come out to $250,000. The at-fault driver's policy pays its limit of $15,000. What happens to the other $235,000? Without underinsured motorist coverage, that's your problem. It's a debt that could bankrupt you, destroy your savings, and ruin your future. But if you have $250,000 of UIM coverage, your own insurance company will pay you that remaining $235,000. It fills the gap between the other driver's pathetic policy limit and the actual cost of your injuries. These 3 coverages, MedPay, PIP, and UM/UIM, form the shield that protects your body, your health, and your bank account. They are the selfish part of your policy because they have nothing to do with the damage you cause to others. They are entirely focused on making you whole when you become a victim on the road. Not having them or having limits that are too low is the equivalent of going into financial battle with a cardboard sword. We've now covered the complex web of protections for the people inside the car. But what about the car itself? What happens when your $50,000 truck is totaled by a hit-and-run driver in a parking lot? Or when a hailstorm makes it look like a golf ball? Or when you yourself make a mistake and slide on some ice into a guardrail? Protecting your physical vehicle is a completely different side of the policy, with its own rules, its own deductibles, and its own critical decisions you have to make. This side of your policy is all about your stuff. Your metal, your glass, your investment. And it's broken down into 2 main categories that are so important, yet so often misunderstood. They are collision and comprehensive. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, a telephone pole, a fence, a building, or that icy guardrail we just talked about. If you flip your car over in an accident, that's also covered under collision. The most important thing to understand about collision coverage is that it pays out regardless of who is at fault. If someone runs a red light and plows into you, their liability insurance should pay for your car. But we all know dealing with other people's insurance can be slow, painful, and sometimes they fight you every step of the way. If you have collision coverage, you can just turn to your own insurance company. They'll pay to get your car fixed right away, and then they'll do the hard work of going after the other driver's insurance company to get their money back. This process is called subrogation, and it's a huge stress reliever. And if you are the one who makes the mistake, if you back into a pole in a parking garage or misjudge a turn on a slippery road, collision coverage is your safety net. It's the coverage that fixes your car when you are the cause of the accident. Without it, you're paying for those repairs entirely out of your own pocket. So that's collision. Covers, well, collisions. But what about all the other crazy things that can happen to a car? What about the hailstorm that turns your car's roof into a golf ball? What about the deer that decides to play chicken with you on a country road at midnight? What if you wake up one morning and your car is just gone? Stolen from your driveway? Or maybe it's not gone, but someone smashed the window and vandalized the interior. What about a flood? A fire? A tree branch falling on it during a windstorm? None of those are collisions. You didn't collide with the hail. You didn't collide with the thief. This is where the second part of physical damage coverage comes in. Comprehensive coverage. Some companies call it other than collision coverage, which is actually a perfect description. It's the catch-all for almost everything else. Think of comprehensive as the weird stuff coverage. It's for damage to your car that's not caused by a collision. Hail, fire, theft, vandalism, floods, falling objects, riots, and hitting an animal. All of that falls under comprehensive. That deer that jumped out in front of you? Even though you technically collided with it, it's considered a comprehensive claim, not a collision claim. Why? Because the deer is an unpredictable act of nature, not a driving error. This is actually good news because comprehensive claims are far less likely to raise your rates than at-fault collision claims. So you have these two buckets, collision for crashing into things and comprehensive for pretty much everything else. Now here comes the first big catch. The single most important concept you need to understand when it comes to getting your car fixed: the deductible. Both collision and comprehensive coverages have a deductible. A deductible is the amount of money you have to pay out of pocket for a claim before your insurance company pays a single penny. It's your share of the risk. Let's say you have a $500 deductible on your collision coverage. You slide on that ice and do $4,000 worth of damage to your car. You file a claim. You pay the first $500 directly to the body shop. Your insurance company then pays the remaining $3,500. If the damage was only $400, it's not even worth filing a claim, because the entire repair cost is less than your deductible. You just pay for it yourself. Deductibles can range from $0 all the way up to $2,500 or more. And here's the trade-off. The higher your deductible, the lower your premium will be. If you're willing to take on more of the initial financial risk by choosing a $1,000 deductible, the insurance company will reward you with a cheaper policy. If you want a low deductible, like $250, you're shifting more of the risk to the company, so they're going to charge you a higher premium. So how do you choose? The answer is simple, but it requires honesty. You should choose the highest deductible you can comfortably afford to pay at a moment's notice. Don't pick a $1,000 deductible to save $15 a month if you don't have $1,000 in an emergency fund. Because when an accident happens, that bill is due right now. Okay, so you've had an accident, you've paid your deductible, but then the body shop calls with bad news. The damage is so severe that the car is a total loss. The insurance company is going to total your car. This is where the second and arguably more painful catch comes into play. It's a concept called actual cash value. When an insurance company pays you for your totaled car, they do not pay you what you paid for it. They do not pay you what it costs to buy a brand new one. They pay you what your car was worth the second before the accident happened. This is its actual cash value, or ACV. And the biggest factor that determines ACV is depreciation. The moment you drive a new car off the lot, it starts losing value. A car you bought 3 years ago for $30,000 might only have an actual cash value of $18,000 today. So if that car gets totaled, the insurance company is going to write you a check for $18,000 minus your deductible. This is the #1 source of frustration and anger for people dealing with a total loss claim. They feel cheated. They say, "But I can't buy another car like mine for $18,000. And they might be right. But the policy is designed to pay for the value you lost, not to buy you a brand new asset. It's a brutal reality of how insurance works. This reality creates a very dangerous financial situation for millions of people. Being upside down on a car loan. Let's say you still owe $22,000 on the loan for that car that's only worth $18,000. The insurance company gives you a check for $18,000. You hand that entire check over to the bank, but you still owe them another $4,000. You are now left with no car, and a $4,000 bill for a vehicle that doesn't even exist anymore. It is a financial nightmare. But there is a solution. It's an optional coverage called gap insurance. Gap insurance does exactly what it sounds like. It covers the gap between what your car is worth, the ACV, and what you still owe on your loan or lease. In our example, after the insurance company paid its $18,000, your gap insurance would kick in and pay the remaining $4,000 balance to the bank, leaving you with a zero balance. If you are financing or leasing a new car, and especially if you didn't make a large down payment, gap insurance isn't just a good idea. It is absolutely essential financial protection. Now, for those who want to avoid the actual cash value problem altogether, there is another, more premium option. It's called new car replacement coverage. This is an endorsement you can add to your policy, usually only for cars that are very new, maybe 1 or 2 years old at most. Costs more, but it does exactly what it says. If your brand new car gets totaled, instead of just giving you the depreciated actual cash value, the insurance company will pay to replace it with a brand new car of the same make and model. It completely bypasses the pain of depreciation, giving you a fresh start. So, when we talk about protecting your car, it's a three-part puzzle. First, choosing your coverages, collision and comprehensive. Second, choosing your risk level, your deductible. And third, understanding your payout, whether it's the standard actual cash value, or if you've protected yourself further with gap or new car replacement. Getting these choices right is the key to making sure a bad day on the road doesn't turn into a long-term financial disaster. We've now covered protecting other people from your mistakes, and we've covered protecting your own vehicle. But there's a massive piece of this puzzle still missing. What happens when you get hurt? What about your passengers? And what happens in the terrifyingly common scenario where the person who hits you has no insurance at all? That empty feeling when you realize the other driver is broke and uninsured. That's a whole other level of risk we need to prepare for. This is where the entire system can break down. You did everything right. You bought liability insurance to protect others. You drove safely. But the person who smashed into your driver's side door was texting, driving a beat-up sedan, and when the police officer asks for their insurance card, they just shrug. They don't have one. In that moment, their financial problem becomes your catastrophic medical and financial crisis. And this happens far more often than you think. In some states, nearly 1 in 4 drivers on the road with you right now is uninsured. 1 in 4. Let that sink in. So, how do you protect yourself from the financial irresponsibility of a total stranger? This is where your own insurance policy needs to become your hero. You need a coverage that steps in and acts like the insurance the other driver should have had. This hero has a name: Uninsured Motorist Coverage, or UM for short. Let's be crystal clear about what this does. Uninsured motorist coverage pays for your injuries and the injuries of your passengers when you are hit by a driver who has no liability insurance. It's that simple. Think of it as a ghost policy. The other driver hits you, but they're a financial ghost, there's nothing there. So your UM coverage materializes and takes the place of their non-existent policy. It's broken down into 2 main parts. The first, and by far the most important, is Uninsured Motorist Bodily Injury, or UMBI. This is the coverage that protects your most valuable asset, your health and your ability to earn a living. If an uninsured driver puts you in the hospital, your UMBI can cover your medical bills, from the ambulance ride to the surgery to the physical therapy. It can cover your lost wages if you can't work for weeks, or months, or even permanently. And in many states, it can also provide compensation for pain and suffering, the non-economic toll that a serious accident takes on your life. Without UMBI, you're at the mercy of your own health insurance, which comes with deductibles, copays, and coverage limits. And your health insurance certainly isn't going to pay you for the weeks of work you missed or the chronic pain you now have to live with. You could try to sue the uninsured driver personally, but as the saying goes, you can't get blood from a stone. If they couldn't afford a basic insurance policy, it's almost certain they don't have tens or hundreds of thousands of dollars in assets sitting around to pay for your recovery. With UMBI, you're not chasing a ghost. You're making a claim with your own trusted insurance company. But there's a second, more insidious villain on the road. It's not just the uninsured driver you have to worry about. It's the underinsured driver. This is the person who did the absolute bare minimum. They bought the cheapest policy they could find with the lowest possible state-required liability limits. In some states, that might be just $25,000 for bodily injury. Now, imagine you're in a serious accident caused by one of these drivers. You have a shattered leg, require multiple surgeries, and rack up $100,000 in medical bills, not to mention the lost income. The at-fault driver's policy maxes out at $25,000. Their insurance company writes you a check for that amount and that's it. They're done. Their legal obligation is fulfilled. You are still left with $75,000 in medical debt and a massive financial hole. This is where Underinsured Motorist coverage, or UIM, saves the day. It's the second half of this heroic duo. UIM coverage kicks in when the at-fault driver has insurance, but their liability limits aren't high enough to cover your bills. It bridges the gap. In our example, after you receive the $25,000 from the other driver's policy, you would then turn to your own insurance company and file a UIM claim. If you had $100,000 in UIM coverage, it could pay the remaining $75,000 of your bills. It fills the gap that the other driver's cheap policy left behind. Together, UM and UIM are your shield against the financial devastation caused by irresponsible drivers. And here's the critical piece of advice that almost no one tells you. Your UM/UIM coverage limits should, ideally, be the exact same as your own bodily injury liability limits. If you've decided that you need $250,000 of liability coverage to protect your own assets if you cause an accident, why on earth would you accept less protection for yourself if someone else does the exact same thing to you? You are essentially saying that your own health, your own family's well-being, is worth less than that of a stranger you might hit. It makes no sense. Match your limits. It is one of the most powerful and surprisingly affordable ways to fortify your financial life. Now, what about your car? If an uninsured driver totals your brand new SUV, who pays for that? This is where the property damage side of this coverage comes into play. It's called Uninsured Motorist Property Damage, or UMPD. This coverage, if you have it, will pay to repair or replace your vehicle if it's damaged by a documented uninsured driver. It's a great safety net. However, there's a big overlap here with another coverage we'll discuss soon: collision. Collision coverage pays for damage to your car regardless of who is at fault, whether it's an uninsured driver, a deer, or a pole in a parking garage. Most people have one or the other, not both. If you have collision coverage, you generally don't need UMPD because your collision policy would handle the repairs. The main difference often comes down to the deductible. UMPD deductibles are often much lower than collision deductibles, sometimes as low as $100 or $250. So, if you're hit by an uninsured driver, using UMPD could save you some out-of-pocket cash compared to your $500 or $1,000 collision deductible. It's a small detail, but one worth checking on your own policy. Now, let's talk about a power-up for this coverage that many people don't even know exists. It's called stacking. This is a feature you can often add to your UM/UIM coverage, and it's especially important for families with more than one car on their policy. Let's say you have two cars, and you have $100,000 of UIM coverage on each one. If you get into a serious accident, non-stacked coverage means you only have access to the $100,000 limit of the specific car you were driving. But if you pay a little extra for stacked coverage, you can combine or stack the limits from all the cars on your policy. So in that same scenario, you could potentially access the $100,000 from the first car plus the $100,000 from the second car, giving you a total of $200,000 in available coverage. If you have three cars, you could stack it to $300,000. This is an incredibly powerful way to multiply your protection for a relatively small increase in your premium. Not all states offer it, and the rules vary, but if stacking is available where you live, it is absolutely something you should ask your agent about. It can be the difference between a full recovery and a lifetime of debt. The bottom line is this: you cannot control the decisions of other drivers. You can't force them to be responsible. You can't force them to buy insurance. The only thing you can control is how well you prepare for that inevitable moment when their bad decision intersects with your life. Relying on other people to do the right thing is not an insurance strategy. It's a gamble. An uninsured and underinsured motorist coverage is the tool that takes the gamble off the table. It's the single most important coverage you can buy to protect yourself and your family from physical and financial harm on the road. So you've protected yourself from at-fault drivers with liability, and now you've even built a fortress against the uninsured and underinsured. You feel secure. But what about the threats that don't involve another car at all? The hailstorm that turns your car into a golf ball overnight? The tree branch that snaps in a windstorm and crushes your roof? Or the thief who smashes your window and steals everything inside while you're at a concert. These are the random, unpredictable acts of nature and malice that can be just as costly. This isn't about fault, it's about fate. And for that, you need an entirely different kind of protection. This protection is known as physical damage coverage, and it's a two-headed beast, a dynamic duo that protects your actual physical car. Their names are comprehensive and collision, and while they're often sold together, they are two entirely different warriors fighting two entirely different battles. They don't care about lawsuits or medical bills. Their sole mission is to repair or replace your vehicle when it gets wrecked. Let's start with the first one because it covers the things that feel the most unfair. It's called comprehensive coverage, but a better name for it would be anything but a collision coverage. This is your shield against chaos. It's for the damage that happens when your car is just sitting there, minding its own business, or when you encounter something completely unexpected on the road. Imagine this. You just bought a new car. Not brand new, but new to you. It's a deep metallic blue, and it's the single most expensive thing you've ever owned. You've been working double shifts for a year to save up for it. You wash it every weekend. You park it in the furthest, safest spot in the parking lot. It's your pride and joy. One afternoon, you're at work looking out the window, and the sky turns a sickly greenish gray. The weather alert on your phone buzzes. Severe thunderstorm. Then you hear it. A faint tink tink tink. Then it gets louder. Asterisk thwack. 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 Asterisk, it's hail. But it's not just hail. It's the size of golf balls. Then baseballs. The sound is deafening, like a drum solo on every car in the lot. You can't do anything. You just have to stand there and watch as nature unleashes its fury on your prized possession. When the storm passes, you walk outside. The parking lot looks like a war zone. And your car, your beautiful metallic blue car, looks like the surface of the moon. It's covered in hundreds, maybe thousands of dents. The windshield is shattered. The sunroof is a spiderweb of broken glass. It's heartbreaking. You know instantly the liability coverage we talked about? Useless here. You didn't hit anyone. No one hit you. This was an act of God. This is where comprehensive coverage steps in. You pull out your phone, you call your insurance company, and you file a comprehensive claim. This is the coverage for fire, theft, vandalism, falling objects like a tree branch, floods, riots, and yes, hail. It also, famously, covers hitting an animal. If a deer jumps out in front of you and you can't avoid it, that's a comprehensive claim. The logic is that you couldn't have reasonably prevented it. The deer hit you as much as you hit the deer. Now, here's the first critical detail you need to understand. The deductible. When you file a comprehensive claim, it's not a free pass. You have to pay a portion of the repair costs first. This is your deductible. It's typically a round number like $250, $500, or $1,000. You choose this amount when you buy your policy. Let's say you have a $500 deductible. The body shop estimates the hail damage will cost $8,000 to repair. You pay the first $500 directly to the body shop, and your insurance company pays the remaining $7,500. Why have a deductible? It's to prevent people from filing claims for every tiny scratch and ding, which would drive premiums through the roof for everyone. It also makes you a partner in the risk. By choosing a higher deductible, say $1,000, you're telling the insurance company you're willing to handle more of the smaller costs yourself, and in return they give you a lower premium. But what if the damage is worse? What if the insurance adjuster comes out, looks at your pockmarked car, and says the $8,000 to repair it is more than the car is even worth? This is when they declare the vehicle a total loss. And this is where we encounter the second critical concept, actual cash value, or ACV. This is one of the most misunderstood parts of auto insurance. Your insurance company isn't going to pay you what you paid for the car. They're not going to buy you a brand new one. They are going to pay you what your car was worth the second before the hailstorm hit. That's the actual cash value. It's the original price minus depreciation. The loss in value due to age, wear and tear, and mileage. So if your car was worth $7,000 before the storm, they'll cut you a check for $7,000, minus your $500 deductible. You'll get $6,500, and the insurance company takes possession of your wrecked car to sell it for scrap. It can be a tough pill to swallow, realizing your car was worth less than you thought, but that is how standard policies work. So that's comprehensive. It's your shield against the universe. But what happens when the damage isn't from the universe but from you? What happens when you are the one at fault? Let's change the scene. It's a cold January morning. There's a thin, almost invisible layer of black ice on the road. You're driving a little too fast for the conditions, maybe you're late for a meeting, and you take a corner. The tires lose their grip. For a terrifying second, you are no longer a driver. You are a passenger in a 4,000-pound sled. The car slides, spins, and slams sideways into a telephone pole with a sickening crunch. The airbags deploy. You're shaken up, but okay. The car, however, is not. The entire passenger side is caved in. You call your insurance. You didn't hit another car, so whose liability pays for this? Nobody's. Bodily injury and property damage liability are for paying for other people's stuff when you're at fault. They do absolutely nothing for your own car. You were at fault in a single vehicle accident. Without a different kind of coverage, you are on your own. That repair bill, or the cost of a new car, is coming directly out of your pocket. This is the exact scenario for the other half of the dynamic duo: collision coverage. Collision is brutally simple. It pays to repair or replace your car when it's damaged in a collision with another object, or if it overturns. It doesn't matter if you hit another car, a pole, a guardrail, a garage door, or a pothole that causes you to lose control and roll. Crucially, it pays out regardless of who is at fault. If someone runs a red light and T-bones you, you can file a collision claim with your own company to get your car fixed fast, and let them worry about chasing down the other driver's insurance for reimbursement. Or, if you're the one who messed up, like in our black ice scenario, collision coverage is your savior. Just like comprehensive, collision has a deductible. It works the exact same way. If the repair cost for hitting that pole is $10,000 and you have a $1,000 collision deductible, you pay the first $1,000, and the insurer pays the next $9,000. And just like comprehensive, it pays out on an actual cash value basis. If the car is totaled, you get what it was worth a moment before the crash, minus your deductible. Now, this brings us to the big question. Do you actually need these coverages? Unlike liability insurance, no state in the country legally requires you to carry comprehensive or collision. So why does almost everyone with a decent car have them? One simple reason: the bank. If you have a loan or a lease on your vehicle, your lender will 100% require you to have both. Think about it. Until you pay it off, that car is the bank's asset. It's their collateral for the loan. They are not going to let you drive their multi-thousand-dollar asset around without full protection. If you wreck it, they want their money back, and your insurance policy guarantees that. But what if you own your car outright? No loan, no lease. The title is in your name, free and clear. Now the decision is entirely yours. It becomes a question of personal finance and risk tolerance. You have to ask yourself one honest question. If my car were totaled tomorrow, could I afford to replace it out of pocket without causing a major financial crisis in my life? If your car is a 15-year-old beater worth $2,000, paying $500 a year for collision coverage with a $1,000 deductible makes absolutely no sense. You're better off self-insuring, saving that money and accepting the risk. But if you're driving a $40,000 SUV that you rely on to get to work and shuttle your kids around, going without comprehensive and collision is a massive gamble. One hailstorm, one patch of black ice, and that $40,000 asset could become a worthless heap of metal. So now your car is in the shop after a covered claim. You're feeling relieved. Insurance is handling the massive repair bill. But then a whole new set of problems starts to appear. The body shop says the repairs will take 3 weeks. How are you supposed to get to work? The tow truck that brought your car from the crash site just sent you a bill for $300. And you realize the expensive child safety seat that was in the back is now mangled and unsafe to use. Your main policy, the comprehensive or collision coverage, won't touch any of this. These are the secondary, hidden costs of an accident that can bleed you dry, and they require a whole different set of optional coverages to protect you. Let's start with the most common one, the one that blindsides people in the days immediately following a crash: rental reimbursement coverage. You might also see it called transportation expense or loss of use coverage. It sounds simple, but its absence can create a logistical and financial nightmare that spirals out of control. Picture this: you're a single parent. You rely on your minivan for everything. It's your mobile command center. It gets the kids to school and soccer practice. It gets you to the job that pays the bills. It's how you get groceries, go to the doctor, and maintain any semblance of a normal life. Then one afternoon someone runs a red light and T-bones you. Everyone is okay, thankfully, but your minivan? It's totaled. The tow truck hauls away the twisted metal, and you're left standing on the curb with your insurance card and a profound sense of dread. Your collision coverage will eventually pay you for the value of the van, But that takes time. The adjuster needs to inspect it, they need to do their valuation, they need to process the paperwork and cut a check. This can take weeks. What do you do tomorrow morning? How do you get your kids to school? How do you get to work? You start looking at rental cars. You need something big enough for the car seats, something safe. You quickly discover that a minivan or an SUV rents for $80, $90, $100 a day or more, plus taxes and fees. Suddenly, you're looking at a $3,000 bill for a month-long rental, a bill you have to pay out of pocket right now while you wait for your insurance settlement. This is where people's lives unravel. They burn through their emergency savings. They max out credit cards. They start taking expensive Ubers everywhere, watching their bank account drain with every trip. They miss work. They fall behind. This is the crisis that rental reimbursement is designed to prevent. For a few extra dollars a month on your premium, this coverage steps in and pays for a rental car while yours is being repaired or replaced. Now, it's not a blank check. A typical policy might offer something like $30 a day for a maximum of 30 days, or a total of $900. And you need to be honest with yourself. $30 a day in today's market won't get you that minivan. It might get you a compact sedan if you're lucky. So, it's critical to look at your policy and pay for a limit that actually reflects reality. You can often upgrade to $50 or even $75 a day for a very small increase in your premium. It is one of the most valuable optional coverages you can buy, because it protects your ability to function in the modern world after a crash. It keeps your life moving forward, while the financial gears of the insurance claim slowly turn. Closely related to this is another small but mighty coverage: towing and labor. When your car is disabled on the side of the road, whether from an accident or a mechanical failure, it needs to be moved. Tow is not cheap. Depending on the distance, the time of day, and your location, a single tow can easily cost you hundreds of dollars. If you're in a rural area, it can be even more. Towing and labor coverage is exactly what it sounds like. It pays for the cost of towing your vehicle to the nearest qualified repair shop. The labor part usually refers to the work that can be done right there on the roadside. Things like changing a flat tire, jump-starting a dead battery, or delivering a few gallons of gas if you run out. Think of it as a basic form of roadside assistance baked into your auto policy. Again, the cost for this is usually minimal, often less than a single cup of coffee per month, but the peace of mind is immense. Having this coverage means that when you're in a stressful, vulnerable situation on the shoulder of a highway, you make one phone call to your insurance company's roadside service line, and help is on its way. You don't have to haggle with the tow company or worry about a surprise bill. It's handled. Now let's move on to a coverage that isn't about convenience, but about saving you from financial ruin. It's called gap insurance. This is one of the most misunderstood but critically important coverages, especially if you finance or lease a new car. To understand gap, you first have to understand a brutal financial reality: depreciation. The second you drive a brand new car off the dealership lot, its value plummets. It can lose 20% or more of its value in the very first year. The problem is, your car loan doesn't shrink that fast. For the first few years of your loan, you are almost certainly upside down, meaning you owe more on the car than the car is actually worth. The difference between what you owe and what it's worth is the gap. And this gap is a financial time bomb. Let's imagine you buy a new SUV for $40,000. You put $2,000 down and finance the remaining $38,000. 1 year later, you get into a serious accident, and the car is declared a total loss. Because of that first-year depreciation, your insurance company determines the actual cash value, or ACV, of your SUV is now only $30,000. That's the most they will pay you. It's what the car was worth the second before the crash. But you've only been paying on your loan for a year, so you still owe the bank $35,000. Do you see the problem? The insurance company sends a check for $30,000 directly to your lender. You are now left with no car, and a bill from the bank for the remaining $5,000. You are legally obligated to continue making payments on a vehicle that no longer exists. It is one of the most soul-crushing financial situations a person can face. This is where gap insurance becomes your hero. It is specifically designed to cover that exact difference. In our scenario, the gap coverage would pay the $5,000 shortfall to the lender, wiping your slate clean. It bridges the gap between your insurance payout and your loan balance, allowing you to walk away from the totaled car with zero debt. You don't get any money in your pocket, but you're not shackled to a phantom car payment. Who needs this? Anyone who makes a small down payment, finances for a long term like 60 or 72 months, or buys a car that depreciates quickly. If you're leasing a car, it's almost always required, and for good reason. Now there's an even better, more premium version of this protection, often called new car replacement coverage. Think of it as gap insurance on steroids. While gap just gets you back to zero, no car but no debt, new car replacement aims to make you whole again. If you have this coverage and your new car is totaled, typically within the first year or two of ownership and under a certain mileage, the insurance company won't just give you the depreciated actual cash value. They will pay to replace it with a brand new car of the same make and model. Let's go back to that $40,000 SUV. It gets totaled a year later. Instead of just getting the $30,000 ACV, new car replacement coverage would give you the full amount needed to go buy a brand new current model year version of that same SUV. It effectively erases the depreciation that happened in that first year. It's more expensive than gap coverage and not all companies offer it. But if you've just made a massive investment in a new vehicle, it provides the ultimate peace of mind. An accident won't force you to downgrade or take on a new loan for a lesser vehicle. These coverages, rental reimbursement, towing, gap, and new car replacement, form a critical safety net. They handle the secondary financial shocks of an accident, the ones that happen after the initial impact. They protect your lifestyle, your savings, and your financial future. But all of this assumes the accident is handled cleanly through your own collision coverage or the other driver's liability policy. But what happens when it's not clean? What happens when the person who crashes into you, the one who was clearly texting, who ran the red light, who caused thousands of dollars in damage to your car and put you in the hospital, what happens when that person doesn't have insurance? Or worse, what if they just drive away, disappearing into the night, leaving you with the wreckage and the medical bills? This isn't a rare, far-fetched scenario. The Insurance Research Council estimates that about 1 in every 8 drivers on the road is uninsured. 1 in 8. Think about the next 8 cars that pass you. Statistically, one of them is a financial time bomb, driving without the safety net that the law requires. If they hit you, their legal responsibility to pay for your damages is worthless. You can't get blood from a stone, and you can't get a settlement from an empty bank account. So what happens then? Are you just out of luck? Is your financial life ruined because someone else broke the law? This is where your own insurance policy can become your absolute hero. It's where two of the most important, yet often misunderstood, coverages come into play: uninsured and underinsured motorist coverage. Think of these as your personal bodyguard. They protect you from the irresponsible and the unprepared. Let's start with uninsured motorist coverage, or UM. This coverage steps in when you're hit by a driver who has no liability insurance at all. It also, crucially, often covers you in the event of a hit and run, where the at-fault driver is never identified. Your uninsured motorist coverage essentially puts on a costume and pretends to be the insurance that the other driver should have had. It pays for the things their liability policy was supposed to cover. There are 2 main parts to this. First, uninsured motorist bodily injury, or UMBI. This is the big one. This covers your medical bills, your passengers' medical bills, lost wages if your injuries prevent you from working, and even compensation for pain and suffering. Imagine you're a freelance graphic designer and a hit-and-run driver breaks your arm and your wrist. You can't work for 3 months. Your health insurance might cover the hospital visit, but who's going to pay your mortgage? Who's going to compensate you for the lost income and the sheer agony of the experience? That's what UMBI is for. It's a financial lifeline. The second part is uninsured motorist property damage, or UMPD. This, as the name implies, covers the damage to your car. Now you might be thinking, wait, doesn't my collision coverage do that? And you're right, it does. UMPD and collision can overlap. The key difference is often the deductible. In some states, the UMPD deductible is much lower than your collision deductible. So if an uninsured driver hits you, you could use your UMPD to get your car fixed and only pay, say, a $250 deductible instead of the $1,000 deductible on your collision policy. In some states, UMPD isn't available because collision coverage is expected to handle it. The key is to know what your policy says. But the real power here is in protecting your health and your income. Without UMBI, your only recourse against an uninsured driver is to sue them personally. And good luck with that. The legal fees are enormous, and even if you win, the person likely has no assets to pay you with. You win a piece of paper, a judgment, but not the money you need to put your life back together. Uninsured motorist coverage lets you bypass that nightmare and file a claim directly with your own trusted insurance company. Now let's talk about its equally important twin, underinsured motorist coverage, or UIM. This one is more subtle, but it can be just as critical. Underinsured motorist coverage protects you when the at-fault driver does have insurance, but their liability limits are too low to cover the full extent of your damages. Let's go back to our story. You're in an accident, and it's clearly the other driver's fault. This time they're responsible. They didn't flee the scene and they have insurance. You breathe a sigh of relief, but then you discover they only carry the state minimum liability coverage. In many states, that could be as low as $25,000 per person for bodily injury. Now, $25,000 might sound like a lot of money, but in the face of a serious car accident, it evaporates almost instantly. One ambulance ride, a trip to the emergency room, a few x-rays, and a follow-up with a specialist can easily eat up that entire amount. What if you need surgery? What if you require months of physical therapy? What if your medical bills climb to $50,000 or $100,000? The other driver's insurance company will write you a check for their policy limit, $25,000, and that's it. They've fulfilled their legal obligation. You are now left with a $75,000 gap in medical bills, not to mention your lost wages and pain and suffering. This is where underinsured motorist coverage saves the day. Once the other driver's insurance has paid out its maximum, your UIM coverage kicks in to cover the rest, up to the limits you selected on your own policy. So if you have $100,000 in UIM coverage, it could potentially pay that remaining $75,000. It bridges the gap between the other driver's inadequate policy and your actual costs. It ensures that you aren't financially penalized because the person who hit you decided to save a few bucks a month by buying the cheapest policy possible. Now, running parallel to all of this are two other types of coverage you'll see on your policy: medical payments, or MedPay, and personal injury protection, or PIP. People often confuse these with uninsured motorist coverage, but they serve a very different and immediate purpose. MedPay and PIP are what's known as no-fault coverages. It does not matter who caused the accident. If you have this coverage, you can use it. It's designed to pay for your and your passenger's initial medical expenses quickly, without waiting for the long process of determining fault and getting a settlement from the other driver's company. Think of it as health insurance specifically for car accidents. It can cover your health insurance deductible, co-pays, ambulance fees, dental work if your teeth are damaged, and even funeral expenses in a worst-case scenario. It provides immediate cash to handle the bills that start arriving in the mail just days after a crash. The main difference between the two depends on your state. About a dozen states are no-fault states, which means they require drivers to carry personal injury protection, or PIP. PIP is generally more robust than MedPay. In addition to medical bills, PIP often covers a portion of your lost wages and may even pay for essential services you can no longer perform due to your injuries, like childcare or house cleaning. In other states, MedPay is typically an optional but highly recommended coverage. It's usually less expensive than PIP because its scope is narrower, focusing primarily on medical and funeral costs. It won't cover lost wages. So let's put it all together. Imagine the chaotic aftermath of an accident. How do all these pieces work? First, your MedPay or PIP is your first responder. You use it immediately to pay for the ambulance and ER visit, regardless of who was at fault. This prevents you from having to pay huge sums out of pocket right away. Simultaneously, the fault of the accident is being determined. If the other driver is found to be at fault, you file a claim against their bodily injury liability insurance to cover your medical costs, lost income, and pain and suffering. But if you discover that driver has no insurance, you pivot. You file a claim under your own uninsured motorist coverage. Your insurance company then pays you for those same things. Or if the other driver has insurance but their limits are too low, your underinsured motorist coverage will kick in after their policy pays out its maximum. These coverages are not just lines on a declaration page. They are a multi-layered fortress you build around your financial well-being. They protect you from the unknown, from the irresponsibility of others, from the devastating financial consequences of a single moment on the road. Without them, you are betting your entire savings and future income on the hope that every other driver you share the road with is as responsible as you are. And with 1 in 8 drivers being uninsured, that is a very risky bet to make. But these are the coverages that protect you and your car in the event of a crash. What about all the other things that can go wrong? What about getting a flat tire on the highway? Or needing a car to drive while yours is in the shop for a week? And what about that dreaded word gap that your car dealer mentioned when you bought your brand new car? Are these extra coverages worth the money? Or are they just expensive upsells designed to pad the insurance company's pockets? Let's start with that rental car. The official name for this coverage is usually rental reimbursement or loss of use, and it's one of the most misunderstood and yet most valuable add-ons you can get. Imagine this: you're driving home from work, and someone runs a red light T-boning your car. Thankfully, you're okay, but your car is definitely not. It's towed to a body shop, and the mechanic gives you the grim news. With parts delays and the extent of the damage, it's going to be in the shop for at least 3 weeks. Now, the other driver was at fault, so their insurance should pay for everything, right? Including a rental? In a perfect world, yes. But we don't live in a perfect world. The other driver's insurance company needs to investigate, accept liability, process the claim, and all of that takes time. Days can turn into a week can stretch into 2, and all the while you are carless. How do you get to work? How do you get your kids to school? You could pay for a rental out of your own pocket, but at $50, $70, or even $100 a day, that bill is going to skyrocket into the thousands before you see a single dime from the other insurance company. This is where rental reimbursement on your own policy becomes your superhero. For just a few dollars a month, this coverage steps in immediately. While the insurance companies are sorting out who's to blame, your policy pays for you to get into a rental car, up to the limits you've selected. These limits are usually expressed in 2 numbers, like 30/900. That means it would pay up to $30 per day, for a maximum of 30 days, or a total of $900, whichever comes first. You can often buy higher limits like $50 a day or even $75 a day if you need a larger vehicle like an SUV or a truck. It kicks in anytime your car is unusable due to a covered claim under your comprehensive or collision coverage. Accident, theft, hail damage. If your car is in the shop for a covered reason, you have a ride. Is it worth it? Ask yourself one simple question. If you woke up tomorrow and your car was gone for 3 weeks, how much would it disrupt your life? If you work from home and have a second vehicle, maybe you can skip it. But for the vast majority of us who rely on our car as our lifeline, this tiny monthly expense is one of the best bargains in insurance. It's not just paying for a car. It's paying for peace of mind and the uninterrupted continuation of your daily life. Now let's talk about that word that makes new car buyers break into a cold sweat: gap. The salesperson at the dealership probably presented it like a non-negotiable insurance policy for your car loan. They're not entirely wrong, but the way they sell it can feel predatory. So what is it, really? GAP stands for Guaranteed Asset Protection. And to understand it, you need to remember the brutal truth we discussed earlier. Cars are depreciating assets. The moment you drive that brand new $45,000 SUV off the lot, it might only be worth $40,000. A year later, it could be worth $35,000. But guess what hasn't depreciated? Your car loan. You still owe what you owe. Let's play out a nightmare scenario. You buy that new SUV with a small down payment and finance it for 72 months. 1 year into your loan, you still owe $41,000. Then a deer jumps out on the highway. You swerve, you hit a guardrail, and your beautiful new SUV is totaled. Your insurance company does its valuation and determines the actual cash value. What it's worth today is only $35,000. They cut you a check for $35,000, minus your $1,000 deductible, so you get $34,000. You take that check, you pay it towards your $41,000 loan, and you are now left with a $7,000 bill. $7,000 that you have to pay out of your own pocket for a car that is now a twisted heap of metal in a salvage yard. You are literally making payments on a ghost. That $7,000 difference between what you owed and what the insurance company paid is the gap. Gap insurance is specifically designed to pay off that difference. In this scenario, it would have paid that remaining $7,000, and in some cases, it will even cover your deductible. It makes you financially whole, allowing you to walk away from the loan completely free and clear. So, who needs it? You absolutely should have gap insurance if you put less than 20% down on your car, if you finance for 60 months or longer, or if you rolled negative equity from a previous car loan into your new one. Basically, if there's any period of time where you will owe more on the car than it is worth, you need gap. But here is the critical piece of advice. You almost never have to buy it from the dealership. Dealers can mark up the price of gap insurance by 200 or 300%, rolling it into your loan as a one-time fee of hundreds or even thousands of dollars. Before you sign that paper, call your own auto insurance agent. Most insurance companies offer gap insurance as an add-on to your policy for a tiny fraction of the cost. We're talking maybe $5 or $6 a month. That's a huge difference. Once you've paid down your loan to the point where you owe less than the car is worth, you can simply call your agent and cancel it. It's a temporary safety net, not a lifelong commitment. Next up on our menu of optional coverages is roadside assistance. This is another one that can feel like a small price to pay for massive peace of mind. You're on a family road trip, hours from the nearest city, and you hit a piece of debris that shreds your tire. Or you come out of the grocery store on a freezing winter day, and your battery is completely dead. Or, in a moment of distraction, you lock your keys in the car. These are not accidents covered by collision. They're just life. Annoying, stressful, and potentially expensive parts of life. Without roadside assistance, you're on your own. You're frantically Googling tow truck near me, hoping you get someone reputable with no idea what they're going to charge you. That tow could easily be $150. A locksmith could be $100. A jumpstart $75. With roadside assistance on your policy, you just call one number. Your insurance company dispatches a trusted service provider to your location. They'll tow you to the nearest repair shop, jump your battery, change your flat tire with your spare, bring you a couple of gallons of gas if you run out, or get your car unlocked. The cost is usually covered up to a certain limit. 4 pennies on the dollar per day. You're buying a 24/7 national network of help. But here's the pro tip. Before you add this, check to see if you already have it. Many people pay for this service 2 or 3 times over without realizing it. Do you have a AAA membership? That's roadside assistance. Do you have a premium credit card? Many of them offer it as a perk. Did you buy your car new? Most manufacturers include free roadside assistance for the first few years of ownership. So do your homework. If you're not already covered, adding it to your auto policy is often the cheapest and most convenient way to get it. If you are, save your money. Finally, there's a special coverage for a specific type of owner. The enthusiast. The person who doesn't just see their car as a way to get from point A to point B. I'm talking about anyone who has invested their own money into customizing their vehicle. Did you add a $3,000 set of custom wheels? A booming high-end stereo system that costs more than a used car? A custom paint job or a vinyl wrap? What about a lift kit on your truck or accessibility modifications like a wheelchair lift? If your customized car is in an accident, your standard collision or comprehensive coverage will only pay to restore the car to its factory condition. They will replace your $3,000 wheels with the value of the boring stock factory wheels. They'll value your incredible sound system at whatever the cheap, basic factory radio is worth. All that money you invested, it vanishes. This is where custom parts and equipment, or CPE coverage, saves the day. It's an endorsement you add to your policy that specifically covers the value of your aftermarket additions. You typically need to provide receipts and photos to document the modifications, and you and the insurance company agree on an added value. Say $5,000 in custom equipment. Your premium will increase slightly, but now if those parts are damaged in a covered loss, you'll be paid their full value, not the factory spec value. If you have poured your passion and your paycheck into making your car your own, CPE coverage is not an option. It is an absolute necessity to protect your investment. So from rental cars to gap loans, from roadside rescues to custom wheels, these coverages are all about one thing: closing the gaps. They fill in the specific, personal cracks that a standard policy might not cover. They are the tools you use to transform a generic insurance policy into a personalized shield, perfectly shaped to your car, your finances, and your life. So let's bring it all together. Let's look at the entire machine now that we've examined every single gear. We've talked about liability, the fundamental shield that protects you from the financial consequences of harming others. We've talked about collision and comprehensive, the dual guardians of your own vehicle, protecting it from crashes, theft, fire, and the sheer unpredictability of nature. We've explored medical payments and personal injury protection, the coverages that look after the most important thing in any accident: you and your passengers. We've pulled back the curtain on uninsured and underinsured motorist protection, the critical safety net for when the other driver fails in their responsibility. And finally, we've looked at the endorsements, the custom-fit pieces like rental reimbursement, roadside assistance, and gap insurance that tailor the policy to your exact needs. Each of these is a plate of armor. By itself, it offers some protection, but only when they are all assembled correctly, with the right limits, the right deductibles, and the right endorsements for your life, do they form a complete, impenetrable suit. A standard off-the-shelf policy is like a suit of armor that's one size fits all. It might cover the basics, but it leaves gaps. And in the world of accidents and finance, A gap is all it takes for disaster to strike. To really understand the power of this, forget the jargon for a moment. Forget declarations pages and liability limits. Let's talk about two people. Let's call them Alex and Ben. They live in the same town, drive similar cars, and have similar jobs. One rainy Tuesday morning, they both get into an identical accident. A moment of distraction, a slick road, and they each cause a 3-car pileup. Here, their stories diverge dramatically, not because of the crash, but because of the choices they made months or even years earlier. Alex chose the cheap insurance. He searched online for the absolute lowest price to be legally on the road. He got a state minimum policy. In his state, that's $25,000 of bodily injury liability per person, $50,000 per accident, and $25,000 for property damage. He didn't get collision coverage because his car was a few years old and he wanted to save the $100 a month. No rental, no roadside, nothing extra. He paid his bill and never thought about it again. Now it's the day of the accident. The other 2 cars have significant damage, totaling about $40,000. His $25,000 property damage limit is exhausted immediately. That means Alex is now personally on the hook for the remaining $15,000. One of the other drivers has a broken arm and a concussion. Their medical bills and lost wages quickly surpass his $25,000 bodily injury limit. They hire a lawyer. Suddenly, Alex is facing a lawsuit for over $50,000. His insurance company paid out the max and now they're done. The rest is on him. His wages are garnished. His savings are wiped out. And his own car? It's a twisted wreck in a tow yard. And since he had no collision coverage, it's a total loss. He gets nothing for it. He still owes $2,000 on the loan, which he now has to pay out of pocket for a car that doesn't exist. He has no way to get to work because he has no rental coverage. The single act of trying to save $100 a month has now cost him his car, his savings, and his financial future for years to come. That cheap policy turned out to be the most expensive purchase of his life. Now let's look at Ben. Ben also wanted a good price, but his priority was protection, not just price. He spoke with an agent, and he chose a policy with higher liability limits. $100,000 per person, $300,000 per accident, and $100,000 for property damage. It cost him about $40 more a month than Alex's policy. He kept collision and comprehensive coverage on his car, with a $1,000 deductible, and he added rental reimbursement and roadside assistance for an extra $10 a month. It's the day of the accident. Same crash, same damage. The $40,000 in property damage to the other cars? It's completely covered by his $100,000 limit. The medical bills and lost wages for the injured driver? Also completely covered by his $100,000 per person limit. No lawsuits, no wage garnishments. His insurance company handles it all. His own car is also totaled. He pays his $1,000 deductible, and his collision coverage pays him the full actual cash value of his car, which is enough for a significant down payment on a new one. While he's car shopping, his rental reimbursement coverage puts him in a rental car the very next day, so he doesn't miss a single day of work. The tow from the accident scene? Covered by his roadside assistance. Ben's life was disrupted for sure. It was a stressful, terrible day. But it was a manageable problem. It was an insurance claim. It wasn't a financial catastrophe. For about $50 more a month, Ben bought himself a firewall. A firewall that separated a bad day from a ruined life. These aren't just stories. This happens every single day in every city across this country. The difference between a minor inconvenience and total financial devastation is almost never the accident itself. It's the piece of paper you have tucked away in your glove box, or saved as a PDF on your phone. So this brings us to the most important question. What do you do now? You've spent this time learning the theory, but knowledge without action is useless. Your mission starting today is to stop thinking of your auto insurance as a bill. It is not a utility like your water or electricity. It is one of the most important financial instruments you will ever own. It is a multi-$100,000 shield that you are renting for a tiny fraction of its value. So here is your action plan. First, tonight, find your policy. Look for the declarations page. This is the summary, the cheat sheet of your coverage. Find the numbers. What are your liability limits? Do they look like Alex's? Or do they look more like Ben's? Do you have collision and comprehensive? What are your deductibles? A $500 deductible is great, unless you don't have $500 saved up. Maybe a $1,000 deductible is better if it saves you money on the premium that you can then put into an emergency fund. Do you have uninsured motorist coverage? Do you have rental reimbursement? Look at the numbers and ask yourself a simple, brutal question. If Alex's accident happened to me tomorrow, would I be protected or would I be ruined? Second, tomorrow make a phone call. Call your agent or your insurance company's service line. This is not a confrontation. You are a customer seeking to understand a product you pay for. Ask them questions. Can you walk me through my coverages in plain English? What would happen if I was in a major at-fault accident? How much would it cost to increase my liability limits from $50,000 to $100,000? What about $300,000? You will often be shocked to learn that doubling or even tripling your protection can sometimes cost as little as a few cups of coffee a month. It is the single best investment you can make. Ask them to run the numbers. Third, become an intelligent shopper. Don't just type cheap car insurance into a search bar. That's how you end up like Alex. Instead, decide what coverages you need first. Decide on the limits that let you sleep at night. Then, take that exact same list of coverages and limits and shop it around to different companies. Now you're comparing apples to apples. You're comparing the price for the protection you actually need, not just the lowest number a website can flash on a screen. Finally, make this an annual ritual. Set a calendar reminder. Every year, when your policy is up for renewal, take 30 minutes to review it. Did you get a new car? Did your income change? Did you move? Did you start driving for a rideshare company? Life changes and your policy needs to change with it. Understanding what your auto insurance actually covers isn't about being an expert in finance. It's about being the chief financial officer of your own life. It's about recognizing that the greatest risks we face aren't always the most dramatic, but the most common. A simple car accident has the power to undo decades of hard work, savings, and planning. Your insurance policy is the one thing that stands in the way. It's not just about protecting your car. It's about protecting your ability to earn a living. It's about protecting your home. It's about protecting your family's future. The peace of mind that comes from knowing you are properly protected is priceless. It's the freedom to drive without a knot of fear in your stomach. It's knowing that if the worst happens, you have a plan. You have a partner. You have a shield. The most expensive insurance policy you will ever own is the one that fails you when you need it the most. Don't let that be you. Take control. Understand your policy. Protect your world.